Hi guys, just a quick update for bonds and treasury notes, not so much for treasury bills on this video because I think treasury bill yields are just going to be kind of staying flat unless the Fed changes interest rates. Let's talk about what's happening with treasury notes and bonds. There's been a lot of news this week that certainly has affected treasury yields. In fact, let me just pull up a graph that shows you just how drastically these things are changing day to day. This graph here from U.S. Treasury yield curve says a lot about what is happening day to day in Treasury bills. In fact, in the last video I said the theme was buckle up, and it still is really. What I've done here is pin the last 3 days that are available on this website. So in green we have the 10th of October, in red we have the 11th, and in blue we have the 12th. Look at, just as an example, the 20-year Treasury. On the 10th here it was above 5%. Then on the 11th, it dipped down significantly below 5%. And then on the 12th, it shot up even higher than it was on the 10th. This is what we're seeing right now in Treasury yields. And in my opinion, we're going to continue to see things like this. And thus, the theme is buckle up. Of course, in the news this week, we've had 4 events really that have affected bond yields. We've had the CPI report come out. The day before it was the PPI report. Last Friday, of course, the jobs report came out. All of those came out higher than expected, although there are some tidbits of information in there that may indicate that things are a little bit better, but in general, all higher than estimated. That, of course, helps drive up the bond yields. But the other thing that came out this week as well was the Fed meeting minutes. I want to highlight just a few things from those minutes. First of all, I want to highlight a search term that now shows up in the Fed meeting minutes that really wasn't showing up before. If you type in term premium, you're going to see that there are now 3 mentions of that term premium now in the Fed meeting minutes. In the last video that I did at the start of this month, I spent a significant amount of time talking about term premium. Essentially, that is going to be the extra bit of yield that investors expect for allowing their money to be used for a longer period of time, for loaning money to the government or any other entity that issues a bond. We'll get to this more in a minute when we start talking about some of the statements that the Federal Open Market Committee meeting members have been issuing in the past week. The second thing I want to highlight out of these Fed meeting minutes is that there is less of a consensus than there used to be, at least in my opinion. I've highlighted a couple of statements here. The first is that a majority of participants judged one or more increases in the target federal funds rate at a future meeting would likely be appropriate. That is changing the tone of that, just saying majority here rather than that most of them. The other half of this statement is telling here as well. It says, while some judged it likely that no further increases would be warranted. Scrolling down even further in the meeting minute notes here, we see several participants commented that with the policy rate likely at or near its peak, the focus of the monetary policy decisions and communication should shift from how high to raise policy rate to how long to raise those restrictive levels. And really, we're starting to see that more and more. We keep hearing higher for longer. I think the longer part is going to be emphasized even more based on what we're seeing here in these meeting minutes. Now, one might think that based upon this new information coming in on the economy, the CPI, the PPI, the jobs report, that the Fed might stand a higher chance of raising rates at their next meeting that starts at the end of this month. However, when we go to the CME Watch tool, we'll notice that just the converse is happening. You'll see that as time has gone along, the market is predicting that the chance of the Fed raising their rates here at this next meeting has decreased. Essentially, the probability that rates will stay the same has increased here up to almost 90% now. Why would that be? Well, there are a lot of comments from the FOMC committee members this week that probably explain what's happening here. There have been a lot of Federal Open Market Committee members speaking. In fact, on Monday there were 3 of them, on Tuesday there were 4 of them, on Wednesday there were 2 of them again. They've had a lot to say here about whether rates should go up or stay the same, but these 3 headlines here, I think, give us some idea of why the CME Watch Tool website thinks that the chance of the Fed raising rates has gotten less over time with all of these new reports coming out rather than what you might expect. Let's look at these 3 headlines here. First of all, I never thought that I would recognize the Fed bank presidents by their pictures. As a kid growing up, I grew up near Oakland, California. I was a fan of the Oakland A's, and the pictures or trading cards of things that I held were people like Raleigh Fingers, Catfish Hunter, Vida Blue, and Reggie Jackson. Instead, now, if I were to think about the faces that I recognize, it's people like Neil Kashkari, Mary Daly, and Lori Logan, not to mention Susan Collins and Raphael Bostic, and going on and on. Nevertheless, let's look at what the headline here says for Kashkari. Possible higher bond yields mean Fed can do less. Let's look at the subheadline here for Mary Daly. The San Francisco Fed president says tighter financial conditions could lessen the need for further action from the central bank. And then lastly over here with Lori Logan, bond market turmoil could aid Fed policies, says FOMC members. Essentially, these rise in yields, bond yields, U.S. Treasury yields, will do the work of the Fed, because as the 10-year Treasury yield goes up, other things that are priced off that 10-year Treasury yield also go up, things like mortgages and car loans. So that is one reason, I think, probably the big reason why the market, the CME watch tool, is saying that the chance of the Fed raising interest rates here in November is actually getting less. In case you didn't know, you can always find out what the auction results are and the data that goes with those auction results from treasurydirect.gov. If you go to their announcements and results press release page, you can scroll down into here and look for what it is you're looking for. In our case, I'm interested in the 30-year bond results that happened yesterday. There's the auction date, October 12th. What you would do is click on this little mark here that says PDF. You want to make sure you get under the results page. Go ahead and click on PDF. When you do that, you're going to get a page that looks like this, and there's some important things in here. You know, it will tell you things like what the yield was. It'll give you some idea of how much money was involved as well. But we're going to scroll down to the thing that I want to show you. It's way down here in small print, and what it says is bid to cover, and it tells us that the bid to cover yesterday was 2.35. Now, just what does that mean, bid to cover? First of all, you'll just know that it's going to give you a ratio, and that will be how much money was bid for this auction versus how much money was lent out, or the cover part of this. Essentially, a higher bid to cover tells you that there's a lot more interest in this auction, and vice versa, a lower bid to cover means that there was less interest in the auction. Now, we've got to be able to put this bid to cover number of 2.35 in some context. So the first question is, well, what's the average bid to cover? And the answer to that, at least recently, has been 2.39. The second question you might be asking yourself, well, what was the previous bid to cover for the previous auction? I've pulled up the results then for the previous auction that was released on September 13th. 2023, and if we scroll down to bid to cover, we're going to see that it was 2.46. So the previous auction was actually above the average in terms of interest in the auction, and this latest one below the average. Now, that might not seem like much of a difference, 2.46 versus 2.39 versus 2.35, but when you are bidding billions and billions of dollars here, it makes a difference in terms of just how much of the auction one broker-dealer receives. And then they have to find a market, essentially, for all of these treasury bonds that they have acquired. Now, the follow-up question then will be, is this going to be a trend? This is going to be something we're going to want to keep an eye on for these treasury bills and notes. Is the bid to cover going to become less over time? Just one warning, you need to look at these in their correct lanes. By that I mean you'll only want to look at the 30-year compared to the 30-year. Don't be taking the 30-year and comparing it to, say, an 8-week treasury bill. In fact, what I've done here is just pull up an 8-week treasury bill that was released back on June 15th, and you'll notice that the bid to cover for this was 3.06. So each of these will have kind of their average bid to cover, but this is something we're going to want to keep an eye on. Now, I'm going to give you a preview here for what the next video is going to be. It's going to be about the 20-year bond and the 30-year bond in particular, and at least one reason why I am not interested in buying the 20-year bond and the 30-year bond, and I want to make sure that I share that with you all. That's it for today. If this was interesting, give us a thumbs up, and we'd love to have you as a subscriber. I always usually end this video with enjoy your investing, but seeing a lot of the news recently, I'm going to end it instead with saying, do something nice for somebody else.